Hey guys, how's it going? It's Andy from Magoo Investing. Happy Monday. We've been seeing a lot of volatility in the market, especially for the past 2 weeks, where we've had 2 red weeks overall, which if you've been looking for the past couple of months has not happened in a while. And one of the sectors that's kind of been pulling the overall market down has been tech. And in the past couple of videos, I've been talking about the incredible discrepancy that we've seen between the results of the NASDAQ and the Dow Jones. The NASDAQ, being the tech-heavy index, has been outperforming the Dow Jones by around 20% overall, and that's the largest discrepancy we've seen since the dot-com bubble bursting in around the year 2000. We had some interesting earnings reports last week. We had Microsoft that released really good earnings per share and revenue, but it wasn't as good as the market hoped potentially, and shares fell after hours of that. And then you had Intel, which had earnings that were just absolutely brutal. They had some delays on some of their important product lines, and the stock was down around 15 or 16% on Friday. And then you had AMD doing the complete opposite and being very balanced and going up 16%. So tech, which has been the safe haven for the past couple months, might not be the best play anymore. And in today's video, I wanted to talk about 3 stocks that are actually not tech stocks that I'm looking to buy in August of 2020. The reason I say August instead of right now is because at this point, I'm still waiting to see more information about the overall stock market. This week, we have some important earnings reports, stuff like Amazon, Apple, Google, Facebook, some of the major tech stocks that could move the market significantly. So I'm going to wait to see what happens with those earnings reports, and then I'm also curious to see what happens with the CARES Act and some of the extra employment benefits that run out at the end of this month. But before we get started, I do have to say that I'm not a licensed financial advisor, and this is not financial advice. Anything you hear in this video is just giving my own opinions on what I'm going to do with my stock portfolio going forward. Also, if you've been enjoying these videos, really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. I've never done this before, but let's go for 100 likes on today's video. Okay, with that intro out of the way, let's get started and talk about the 3 stocks I'm looking to buy in August of 2020. The first stock in today's video is going to be JP Morgan Chase, ticker symbol JPM. Currently, JP Morgan is trading for $98, and it's down around 30% year to date. If you had came to me like a year ago and asked, we're about to hit a recession, do you want to buy any bank stocks? I'd probably be like, ooh, no, that sounds horrible. But similar to pretty much everything we've seen right about now, nothing makes sense. And this recession is not going to be like a typical recession that we've seen in the past. One of the reasons I do kind of like financial stocks right now, and specifically JP Morgan, is a result of what happened during the financial crisis of 2007-2009. That recession was led by the financial banks having a lot of problems with the subprime mortgage stuff. And as a result, there was a lot of protections that were put in place to make sure that doesn't happen again. We've actually seen that come into play pretty recently, as we had Wells Fargo was forced by the Federal Reserve to actually cut their dividend as a result of the Federal Reserve stress test. This was put in after the last financial crisis for the Federal Reserve to kind of audit these companies to make sure they have enough money to protect themselves going forward. And the Federal Reserve didn't think that Wells Fargo had enough, so they required them to cut their dividend to hold on to more cash. And then another thing that we've been seeing across the board with the financial stocks has been putting money aside for loan provisions. We've seen this with JP Morgan in the last earnings report. They set aside $10 billion, and then the first quarter they set aside $8 billion. What this says to me is their profits are not going to be looking that great right now, but what they are doing is protecting themselves going forward. So right now the stock is down around 30%, and some of the kind of active management that these companies have been doing to protect themselves going into recession makes me feel kind of justified in trying to take a position in these beaten down sectors, considering they have a lot of this protection backed by the federal government. Out of the financial stocks, I was picking between Bank of America and JP Morgan. But the reason I picked JP Morgan, ticker symbol JPM, is based off of the incredible earnings report they just released and how well they've done with their investment banks. In the last earnings report, they had a record revenue posting of $34 billion, and they had $5.5 billion of it coming from investment banking. So when you're looking forward, a lot of the loss provisions are going to be a problem going forward, but a lot of the damage that's potentially going to be done could be counteracted based off of the investment banks. And so when I'm looking at these financial stocks, there are some companies out there like Wells Fargo that did not make that much money off of their investment banks. But for the past decade or so, JP Morgan has been building up their portfolio, and they've done very well. And that makes me feel very confident with them going forward, even buying into a recession. So let me summarize the 3 reasons why I like JP Morgan right now. The first is you're buying a stock at a significant discount, which is not something you can say about a lot of other areas. And then number 2, protection is already in place for a recession. The Federal Reserve was not going to allow these banks to fail again and has required them to put aside a lot of money. And so the earnings reports for the last 2 quarters have looked pretty brutal, and that's why the stock is down significantly. But I don't think the damage is going to be similar to what we saw in 2007 to 2009. So while bank stocks don't sound like a great place to be during a recession, but it seems like they have enough protections in place to make it a worthwhile investment. And then the third reason is from this last earnings report that was very impressive. The fact that they had record revenue during a pandemic and they had the increasing revenue coming from their investment banks made it the third reason why I was comfortable buying JP Morgan in the next month. Putting up the 5-year chart, you can just see how steady the stock has been up until the pandemic where it fell. Then going to the 1-year chart, you can see that the stock got pushed down significantly when the pandemic hit during March, but we've been seeing a positive trend. The stock has been climbing in price and we've been seeing higher highs and lower lows, which is very bullish overall. Let me know what you think about JP Morgan Chase, ticker symbol JPM, in the comment section down below. Next up is going to be a stock from a sector that I was very bullish on for a while and I've kind of cooled off on it overall. But we're back to airline stocks, and then the second stock on this list is going to be Southwest, ticker symbol LUV. While I'm not going to be going in depth about why I like Southwest compared to a lot of the other airline stocks, I actually made a full video talking about that and I'll link that above right now if you want to take a look at that. But I did see something very interesting on the charts and I kind of wanted to take a look at it. And anytime I can use technical analysis to justify taking a position, I'll always do that. So let's head on over to the computer and take a look at what I saw. So here's the Southwest chart. This shows back until early 2017, based off of the movement that we've had so far in 2020. It's pretty irrelevant because we're probably not going to be getting to highs of $67 in the near future. So we're going to slow it down and look at the 180-day chart. I've already charted this, but this support right here is pretty serious overall, around the $30 mark. And so this goes all the way back to the kind of the slow and steady decline, which kind of surprised. When I think of the airline stocks, I would have thought that the decline would have just been like one sharp move. But as you can see, they fell, had a little bit of momentum pushing them back up, retested this, bounced up, and then the momentum towards the end of May pushed it lower. And now we're getting to the point where came down to lows of $22. It has pushed up and it has retested this $30 mark a couple times. So this is the play I'm looking at. As we come in here, I'm going to set an alert around the $31 mark if it breaks below this level. If it breaks below this level, I'm going to watch and see what happens. I think it's very important that you plan out what you're going to do when entering a trade. Some stocks, like the blue chips, I could just buy right into Microsoft tomorrow and be pretty comfortable. But with a stock like Southwest, I want to see what happens. So I'm going to go to a lower time frame when this actually happens, once the alert goes off, probably the 5-day 1 minute. What I'm looking for, let me zoom this out a little bit. I'm be waiting for it to come down into the zone, bounce off of the support around the $30 mark, and then bounce back out. And once it exits that range, I will be buying in. This is the safest play in my opinion because it shows the stock is respecting the support. What we don't want to happen is it comes down into the zone, I buy in, and then it just keeps falling. So the important thing to wait for is I'm going to wait for it to come down into the zone. I'm just going to be watching it for a bit, and when it exits to the upside, that's where I'm going to be taking a position. Going back to the 180-day chart, you have a lot of room to go. I don't think it's going to be retesting this $42 mark anytime soon, but for a long-term investment, if it can go down, test the zone, bounce out of it, I'm going to feel pretty good about it because it's shown that this support is pretty serious, and it's shown it's going to take a lot of serious news to break through it. It had the earnings report last week, did not fall through this support, so we've got a pretty interesting play, and that's what I was kind of identifying on the charts with Southwest, ticker symbol LUV. So overall, Southwest is trading for around $32 and it's down 41% in 2020. While the sector is likely not going to improve anytime soon, the technicals that I saw on the charts and the solid resistance that we're seeing around the $30 mark makes me feel very good about a position. I love trades like this where you can get into a stock with a very set entry point and an exit. If the stock falls below $29, I will consider leaving the position. But I do think that Southwest is the best airline stock out there and I might just hold on to it for a long-term investment. So the three reasons why I really like Southwest is the first is the incredible discount you're getting. Looking at the broader market, you're not going to be able to buy a lot of stocks at a 40% discount. Number two, I think Southwest is the best airline stock overall. While the sector is likely not going to improve anytime soon, Southwest I think is the best prepared to take advantage of a recovery in the demand for airline industry, and I think it's a great long-term investment. Number three, the technical analysis on the charts looks incredible. This is a very stable support and it's been tested a number of times already. So you get a very easy to understand entry and we can see where the stocks can go from there. If it falls below that $29 mark and into the lower territory that was retested down in March, I might consider leaving the position, but I have a good feeling that that support is going to hold and I think this could be a great trade overall. Let me know what you think about Southwest, ticker symbol LUV, in the comment section down below. Alright, the last stock on this list is actually not something I would have picked a couple weeks ago. Up until a couple weeks ago, I probably would have picked its rival. This third stock is going to be PepsiCo, ticker symbol PEP. For the longest time, I've been very bullish on Coca-Cola, ticker symbol KO. I just thought it was a very good recession-proof stock based off of the track record that it's had. But as I mentioned with JP Morgan, this recession is not going to be like the last one. The problems with Coca-Cola comes from a lot of their areas where they're going to be selling a lot of products. Movie theaters, restaurants, and sporting venues are not running at full capacity at this point. So that's why PepsiCo, ticker symbol PEP, is my bet for a long-term investment. Currently, PepsiCo is trading at $136 and it's pretty flat on the year. So compared to the first two stocks that I've talked about in this video, you're not buying at a significant discount. But the difference between this stock is this is a company that would consider buying and holding forever. It has a very solid dividend of around 3%, and the company came out in their last earnings report and said that they're not worried about cutting that anytime soon. There's also a dividend that has annually been increased for the past 40 plus years, so you have a lot of track record to go off of this incredible company. One of the main reasons why I decided to pick Pepsi over Coca-Cola has been their diversity of products. When you look at Coca-Cola, they've been pretty stuck with their just beverages overall, which up until like 6 months ago seems totally fine. But with the pandemic, the diversity of products and the acquisitions that PepsiCo has made over the past decade has really paid off. They've made a lot of money from their Frito-Lay's acquisition. They bought Monster Energy, and then they've been making a lot of money off their Quaker products, which have been increasing in price by 30% during the pandemic. So the three reasons that I like PepsiCo. Number one is their reliance on beverages isn't as strong as something like a Coca-Cola. PepsiCo has a variety of products that have increased in popularity during the pandemic, whereas stuff like Coca-Cola is just kind of stuck when a lot of the places that are normally going to be selling Coca-Cola products aren't open fully right now. Number two is overall stability. When I put up the all-time chart, you can see how well the stock has moved over the past couple decades. And that track record makes me feel very good for a long-term investment. And the fact that I can get it pretty even on the year looks very good to me. And number three, it has a pretty solid dividend of around 3%. And the company has come out recently and said that it's likely not going to be cut. We've had pretty recently a lot of major companies have to cut their dividend as they try to save as much cash as possible. But PepsiCo has the 40 plus years of increasing their dividend, and it's not at any risk of being cut anytime soon. And that's why it's one of the three stocks that I'm looking to buy in August of 2020. These are the three stocks I wanted to talk about. I thought I had a nice variety in this video. You have a financial stock, which buying into a recession 6 months ago would have seemed crazy. Then we're talking about the beaten down airline industry and why I like Southwest, ticker symbol LUV compared to all the other stocks. And then we have a stock that's pretty flat on the year, but I think is a great opportunity to add to a long-term dividend portfolio with PepsiCo, ticker symbol PEP. I thought I picked a nice variety of stocks here, and I'm very curious to see what you guys have to say about these three stocks in the comment section down below. Let me know what stocks you guys are watching going into August. Thanks for watching. I really appreciate all the support, and I will see you on Wednesday.